Welcome aboard. Throughout this exhilarating journey, we'll delve into the depths of bank crises, their impacts on investments, and, most crucially, how to protect your financial security. From diversification to asset allocation, we'll embark on a voyage to explore the strategies that can keep you afloat and steer you towards success. But before we set sail, let's take a moment to acknowledge the gravity of the situation. The bank crisis is no trifling matter, and the potential losses can be staggering. It's natural to feel a bit daunted, but fear not. With the right knowledge and approach, you can conquer the rough seas ahead and emerge triumphant. So, hoist the anchor and unfurl the sails. Let's begin this epic odyssey of financial enlightenment and equip ourselves with the arsenal necessary to navigate the tempestuous waters of the investment world. Chapter 1. Understanding the Bank Crisis. Welcome to the labyrinthine world of finance, where the tides of change are constant and the currents of instability can seem impenetrable. Yet, the ability to comprehend the bank crisis is an indispensable skill in navigating the stormy seas of investments. To begin with, it's critical to fathom the concept of a bank crisis itself. Simply put, it occurs when a plethora of financial institutions fail or become insolvent, setting off a cascade of economic turbulence that can have widespread effects. Numerous factors can contribute to a bank crisis, from economic downturns and excessive risk-taking to fraudulent activities and lax regulation. A perfect storm of triggers can lead to the demise of multiple banks, creating a domino effect. The potential consequences of a bank crisis are significant and far-reaching. They can range from a slump in economic growth to a loss of trust in financial institutions and a spike in unemployment rates. At worst, it can spiral into a recession, with the economy facing a long road to recovery. It's worth noting that bank crises are not rare occurrences. History has shown us that financial institutions can and do fail, and the effects of such events can ripple for years to come. Therefore, it's crucial to keep an eye out for warning signs of a potential bank crisis. By monitoring economic indicators, staying updated on the latest news, and tracking the financial health of institutions, investors can take proactive steps to prepare themselves for any upheaval. To summarize, a thorough understanding of the bank crisis is the first line of defense in managing your investments. By recognizing the various factors that contribute to such crises and their potential repercussions, investors can proactively safeguard their financial future. Chapter 2. How a bank crisis affects your investments. The repercussions of a bank crisis can be felt by investors in multiple ways, and comprehending these effects is critical for informed decision-making in uncertain economic times. One of the most notable impacts is the decline in stock prices, triggered by a loss of confidence in the market as financial institutions fail or become insolvent. Such a drop in stock prices can be detrimental to investors with significant holdings in stocks, causing a sharp decline in the value of their investments. Bonds can also be influenced by a bank crisis, as investors seek out safer investments. However, this increased demand can lead to higher bond prices, resulting in lower yields and reduced returns for investors. Savings accounts can suffer during a bank crisis as well, as the FDs may not have enough resources to cover all deposits, leaving some investors with losses. Moreover, mutual funds holding investments in financial institutions may also be adversely affected, leading to lower returns for investors. In conclusion, investors must be mindful of the potential impacts of a bank crisis on different types of investments. They should stay informed, seek expert guidance, and remain calm while making investment decisions in such times of uncertainty to safeguard their financial well-being. Chapter 3. What to do with your investments during a bank crisis. During a bank crisis, investors may feel like they're navigating uncharted waters. However, there are ways to stay afloat and avoid sinking with the market. The first and most critical step is to diversify one's portfolio. By investing in a range of asset classes and industries, investors can spread their risk and avoid significant losses in the event of a bank failure or market downturn. Another important consideration during a bank crisis is asset allocation. Investors should assess their risk tolerance and adjust their portfolio accordingly. allocating more of their investments to safer assets such as bonds or cash if they have a low risk tolerance. Staying informed is also essential during these times. Investors should pay attention to economic indicators, financial reports, and news that may affect their investments. This information can help investors make informed decisions about their portfolio and adjust it as necessary to protect their investments. During a bank crisis, seeking professional advice can be incredibly beneficial. Financial advisors can provide valuable insight into the current economic climate and offer guidance on how to adjust investments to protect against potential losses. Finally, it's essential to remain calm and avoid making hasty investment decisions. Panic can cause investors to make decisions based on emotions rather than logic, resulting in significant losses. Instead, investors should take a long-term approach and remain focused on their investment goals. In conclusion, a bank crisis may seem like a daunting challenge for investors, but with proper planning and execution, they can protect their investments. By diversifying their portfolio, adjusting their asset allocation, staying informed, seeking professional advice, and maintaining a calm and focused mindset, investors can weather the storm and come out on top. Chapter 4. Protecting yourself from future bank crises. As the old adage goes, hope for the best, but prepare for the worst. While we cannot predict the future, investors can take proactive steps to protect themselves against the impact of future bank crises. By being vigilant and taking measures to safeguard their investments, investors can minimize the potential impact of economic uncertainty. Diversification is key, and investors should continue to spread their investments across different asset classes and financial institutions. This strategy reduces their exposure to any one bank or sector and can help protect their investments in the event of another financial crisis. Investors can also conduct their own research into the stability of financial institutions before investing. Analyzing financial statements, credit ratings, and other indicators of stability can provide insight into the financial health of a bank or other institution before entrusting them with investments. Monitoring the performance of investments is also critical to identifying and mitigating potential losses quickly. By keeping track of investment performance, investors can take swift action to minimize the impact of any potential issue. Investors may also want to consider investing in financial instruments that are less vulnerable to bank crises, such as exchange-traded funds, ETFs, and index funds. These types of investments track the performance of a broader market or index, which can reduce the impact of individual financial institutions' performance. Finally, seeking professional advice is always a good idea. Financial advisors can offer valuable insights and guidance on how to protect investments during times of economic uncertainty. In summary, investors can take steps to protect themselves from future bank crises by diversifying their portfolio, researching financial institutions before investing, monitoring investment performance, considering less vulnerable financial instruments, and seeking professional advice. Investors can safeguard their financial future. So, it's better to be safe than sorry. In conclusion, a bank crisis can be a challenging time for investors, but it's important to remember that there are steps they can take to protect their investments.